The time has come for policy to adjust. That is what Jerome Powell has said during the Fed's annual retreat. We are looking at a possible September rate cut. Now, we've kind of known about this over the last few months, but I think also I want to review a couple things that I've mentioned before, because not only is it time for them to adjust their policy, I think it's also time for us stackers and investors to begin making adjustments as well. And I'm going to make the case for that here in just a second. So I want to talk about gold. What I made a couple videos about this before. It was one of the more recent ones, and I'll link that video in the top here. But price of gold and silver today are shooting up pretty high. Silver's up almost $1. Gold is up just over $32, hitting another all-time high. Silver about to creep back into the $30 threshold here. You know, when the interest rates get cut, that makes a good environment for gold. The dollar index is dropping again, and if we look at it over the last 5 days since the last video, I think it was around last week, the dollar has still been going down. It's almost about to go down below 100. And I think over the last 6 months, it's really just gone down, and noticeably so since around July. So these are going to be good for gold and silver. I mean, these are going to push these prices up. And the adjustment that I was talking about that I want to pay attention to is going to be completely dependent on the 2-year and 10-year spread and what's going to happen, because we already know that the Fed's going to start dropping interest rates. So I'm looking at what the 2-year and 10-year spread is going to do. Now, if you remember about 2 weeks ago, it did actually cross over and uninverted for the first time in almost 2 years, and that's what actually sent the markets down for a little bit. There were a couple other, I think there may have been other reasons, but it really crashed the market down. Not this exclusively, but I'm paying attention for this to uninvert and actually stay above that uninversion line. So it has been creeping back up over the last few days, and while it's still under, I'm watching that creep up, because when that creeps up and when these interest rates drop, that's when things are going to hit the fan. So I'm looking at, what I mean by that, let me show you guys an example of what I'm looking for here. So if you guys remember this picture, this is the 2-year, this is the 2-year, 10-year spread over the last like 30 something years. Every time it has dipped under that uninversion, or during the inversion line, it creeps up, does a little head fake, and then it creeps back up, and then it kind of stays above that. And then these gray lines are recessions. So it happened in the 90s. It happened again. It dipped down here below the inversion line. It happened in the early 2000s in the dot-com bust. And then the GFC, and back in like 2008, happened here again. It dipped below that line and came back up. And then it's been above that line up until about, well, with the exception of 2020, it really has kind of just, it's been so deep under this inversion line for so many years that it's going to start making these head fakes. So if you guys kind of look here, it looks like it does 2 fakes, or 1 or 2 fake outs. So it does a fake out here, comes back up, and then it stays above. Here it actually only went 1 time. Here it did 1 fake out, second fake out, came back down, but then it came back up again. So we'll see what happens around here. I'm still waiting for this to creep above and stay above this line, because there's one other chart that I want to show you guys too, is the Fed's fund rate, because this is all, these gray lines are those exact same recessions as you saw here. And so what we're looking for, because we already know the Fed is expected to cut rates, what's going to happen is recession almost every single time. So at least over the last 30 years, I mean, you can bring this back down even farther to like, I mean, you can go back to the 50s. Every time there's a recession, the Fed just cuts rates. And even with the 2-year and 10-year, if you go back super far, every time it dips out, or we already hit the 90s, but every time it dips down, it causes something. So it's a very strong indicator. I mean, this isn't going to be the absolute guiding principle, but these are just indications of what could happen. If we go back to the Fed's fund rate, every time there's a recession, let me zoom back into the 90s here, because because it's easier to look at this way. Every time the Fed had a interest rate pause, it was always followed by a cut, and then when there was a cut, there was a recession followed by further cuts. It happened in the 90s. It happened here. There's a little flattening. It rises up, it flattens, it drops, recession. It goes back down. The rates drop rapidly. It kind of flattens out, comes right back up, flattens, drops, recession, really intense dropping of the rates. Holds flat for a while, crept up a little bit. 2020 happened. We all know what happened there. But then the interest rate shoots up really high here because they're battling inflation, flattens out, and now they're about to drop it again. But if you look like right around here, you know, it's kind of had the same thing. They've raised the rates, they dropped them, they flattened out, they dropped them, they raised them. Here, nothing really happened, but that's only because the 2-year, because these things have to work together. I want you guys to understand, it's not just because the interest rates flatten out and drop. It's because the 2 and 10-year and the interest rates have the same correlation or the same timing of their patterns. And when those patterns align up, that's when these recessions happen. So every time, and I would say it maybe favors the 2 and 10-year inversion more than it does the interest rate cuts. They're extremely highly correlated. And when that happens, we're going to have a recession. So price of gold, price of silver is probably going to go up in these cases, because I think we're in a different environment than we were back in the earlier ones. I mean, we had the 2020s is definitely going to be the inflationary decade. So it's going to be really good for gold and silver. I'm not giving you guys any recommendations. I'm not giving you guys advice. I'm just telling you guys the patterns that have existed over the last 30 to 50 years. And I want you guys to make your own decision on it. This is how I'm viewing it. And in my position, I'm going to be stocking up on cash. And I'm probably going to sell a lot of stocks, because I don't know when, but soon, whenever this 2 and 10-year uninverts and stays above the inversion line, you probably have a little bit of a couple months to get ready before it really starts. I mean, who knows what's going to happen? But I think, with the Fed signaling that they're going to cut the rates, I am watching this 2-year, 10-year spread like a hawk, because we already know the rates are going to drop. But when this re-inverts or uninverts, whatever the word is, when it uninverts back into the positive and it stays above that positive line, that's when it's going to get bad. And that's when I'm going to be really stockpiled up in cash. I'm going to be buying gold. I'm going to be buying silver. I'm going to be buying more stocks, because they're going to be crashing. So that's just how I think things are going to go down. Let me know what you guys think in the comment section down below. Do you guys believe this 2-year, 10-year graph? Do you believe the Fed interest rates? Do you think there's a correlation? Let me know what you guys think in the comment section. Please don't forget to subscribe, and I'll catch you guys in the next video. Bye-bye, guys.